Welcome back to the Property Trio, the podcast for the sophisticated property buyer. I'm your host, and I'm joined by Dave and Mike as always. This is the second episode in our series where we continue unpacking the key factors that influence how much money can you borrow and how can you use that knowledge to improve your property buying power. In this episode, we'll be diving into what impact dependents have on your borrowing capacity and why the bank treats single parents differently to couples. Also, what the recent cash rate cut means for your borrowing power and what 3 further rate cuts will do for your borrowing capacity. We'll also cover how an increase in your income improves your borrowing capacity and whether it's worth waiting to get that pay bump before looking to purchase. And lastly, we'll look at how lenders treat bonuses, commissions, overtime and other variable incomes differently to your base salary and how policy varies from lender to lender. So let's get into it.
That's an exciting intro. I think often I hear people talk about it being a game of finance, and this is like Dave's going to peel back the curtain and we're going to figure out how to win the game.
I love it. It's so segmented, and that's exactly what people want. The detail's amazing, Dave.
It's the rules of the game.
Yeah.
Excellent.
So, Dave, a lot of people hold off on buying their long-term family home until after they've had kids, often because they're still figuring out the suburb or the town or the city where, they feel comfortable raising their family, or perhaps more truthfully because it takes a while to let go of the childless lifestyle. But from a lending perspective, how much do kids affect your borrowing capacity?
Great question, Kate. Certainly each child is considered a financial liability, and rightly so, because let's face it, kids don't come cheap, do they?
No.
Not only will the little rascals impact the quality of your sleep, they'll also chip away at your borrowing power when it comes to buying that family home, investing, or even refinancing. So let's break down an example, shall we?
Yeah.
So if we've got a couple earning a combined income of $300,000, each child adds a cost of $350 a month to your living expenses under the household expenditure measurement. Okay, so that would reduce the borrowing capacity by about $35,000 per child. But for all of you parents out there, I know you're thinking, my child costs much more than $350 a month. That's not really all that realistic. And it's well noted by those of you who are paying attention, because the household expenditure measurement is designed to reflect a basic but respectable standard of living. So really, for almost all borrowers, your living expenses, which you need to disclose, is going to be higher than the household expenditure measurement. So let's look at a number that might sound more realistic
Yep.
to some of our listeners. So let's say each child actually adds $700 per month to your actual living expenses, which is still only a bit over $8,000 extra a year. That's going to reduce your borrowing capacity by around $70,000 per child. So that's $140,000 less you can borrow with 2 kids, or around a bit over $200,000 with 3, if you have 3 kids like we do, which hurts.
Should have got a puppy, Dave.
Yeah, that's right. So look, that's probably a reasonable cost for most families, but then, you might have full-time childcare, and even after rebates, that can bump up your living expenses. If you have even some of the larger expenses, such as having a nanny or covering private school fees, then your borrowing capacity can be eaten into even further. So let's say if you have 2 kids at private school that cost you $30,000 per year, that's going to bump down your borrowing capacity by about $300,000. And if those costs were to be $50,000 per annum, that's going to reduce your borrowing capacity by closer to $550,000. So with these examples on a $300,000 income, if you have a couple kids and they're both in private school, your property purchase price at an 80% LVR might be reducing from $1.6 million down to $1 million. So it really does impact your borrowing capacity. And nowadays, with all the detail you have to go into your living expenses, private school fees do need to be disclosed separately. And if they're not, the banks will pick them up in your bank statements.
So, Mike, how do things look for single parents?
Yeah, well, I mean, it would make sense that nothing really changes, right? Because kids still cost the same, but the difference with being a single parent is that you're going to have potentially higher costs because you're not able to necessarily share things. So when you don't have that option to share things, there might be a bit more of a reliance on paid services, and there'll be less opportunities for cost saving. So, for example, if you want to go out with a friend, normally you would say to your wife or husband or what have you, can you look after this little rascal for a bit because I'm going to go out? But, as a single person, you might have to rely on babysitting. If you're working full time, the division of labor in the household is different, right? If you're having to do everything and you're not able to sort of share that, then you might rely on having a cleaner or someone to do the lawns, that sort of thing. So the impact of that is reflected in the HEM figures. So each dependent adds $490 per month to the living expenses of a single applicant compared to that $350 that Dave was sharing before in a couple household. So that's $140 per month per child as an extra for single parents. And of course, that will feed into the borrowing capacity. So if you're a single person, using Dave's example as well, on the 150K, so half of the 300, each child could reduce your borrowing power by around 60K, as opposed to 35K for a couple. Single parenting is a difficult thing, but of course now you've got the extra kick in the backside for your borrowing capacity being reduced. There can be child support that can offset this, but a single earning 150K, looking at an owner-occupier purchase with no meaningful debts for a major lender, you're finding that the savings to complete the reduction, so the property value reduction, would be 74K for one person or 150 if you've got the two children. So it does make a meaningful difference.
Yeah,
Yeah,
definitely.
there's certainly is a sting in the tail with kids when it comes to your borrowing capacity. That's for sure. Look, another key factor to consider when planning for children also is the likelihood that one parent is going to need to take time away from work. So most couples in particular, or a single, is going to be temporarily moving from a dual income to a single income family. So if, let's say, that one partner who chooses to take the time off work, uh, leading into and after having a child or children, let's say they were earning $80,000 a year, that would reduce your borrowing capacity by around $500,000. The good news is if you can provide a letter from your employer confirming your return to work date, employment basis, and expected salary, many lenders will assess your future income rather than your current reduced um, income whilst you're on parental leave. However, if you're unable to provide that confirmation, and from my experience, not everyone's locked into what they're going to be doing when they do return from work, you will, actually only have your parental leave income used towards servicing. So that, and as we know, in many cases, one of the couple will step away from the workforce for many years and doesn't return to full time employment until having two or three children, or maybe perhaps will never return to full time work. So it certainly means that your borrowing power can be restricted on this front as well post having children. And this is often during as we're heading towards or during our peak earning years in our 30s and 40s. So when you combine the higher living expenses of kids, plus the drop in household income, it's really a double whammy to your borrowing capacity, which is why it's so important to sit down and work out your mortgage strategy, get your property planning completed prior to these life events taking place. It doesn't mean you're going to know for certain what your future plans and strategy will be, but you can have a fair idea and you can understand the impacts that are about to hit you in terms of reduced cash flow, reduced borrowing capacity, what that's going to mean for property purchases prior to the events occurring, and you're likely to make different decisions, better decisions. You might pull some decisions forward prior to starting a family.
I wanted to ask you a question about that, Dave, because I'm thinking of a parallel in my head about life insurance, right? So I got my life insurance early because I was sort of taught that, once you've got a policy, they can't take it away depending on how your behaviours might change. And I thought, you know what, one day I'm going to get a motorbike. I want to get my pilot's license. I'm quite interested in cave diving, all this high risk stuff. So I'm just going to go, all right, get my life insurance policy and then make them wish they didn't give it to me. Cate in the
smart.
intro.
That's really smart.
Thanks, Dave.
Make sure you get a level premium and not a stepped premium, and then just stick with that level premium, and they can't price you when you're doing these high risk events.
I got it. I'm just trying to think of more high risk things just to make them more and more nervous. But Cate was kind of saying in the intro that, many people will wait until they have a family to then go and purchase a property. Now, of course, that makes sense because you don't really know exactly what your living expenses are like. You don't know whether, you might say at the outset, I only want to be at home for 3 or 6 months and then I want to go back to work, but then you fall in love with this little squidgy bit of jelly. But from a lending point of view, is it better to secure that loan before having children? Is that something that's, tactically advantageous, like my cave diving insurance stuff?
Yeah, look, it exactly is, and that's why you should look at these options prior. And often what happens is these considerations come after starting a family, and your borrowing capacity is going to be reduced significantly. Your earning capacity is. So, trying to sort these. And look, this applies to, changing jobs or moving from being an employee to becoming self-employed. Or maybe you're going from a higher base to a lower base, but there's much more opportunity to earn commissions and bonuses. So any of these sort of major structural changes, people underestimate how much these changes impact their borrowing capacity, and also they underestimate, which we'll get into a bit of in this episode, the impact of variable income that they earn on their borrowing capacity, because lenders would generally take 100% of your base, but the rest often will be shaded and they won't take all of it into account.
It's a really good point that you raised, Mike, because, the risk averse side of me is looking at it thinking, if you went all out to get your ideal family home and it required both of your incomes and you were hitting the red limiter with your borrowing capacity, will you be worried when you take parental leave that you might not be able to maintain your repayments, or that you'll be putting yourself into a really awkward situation? And obviously you've got to have a really good sound knowledge of what your spending patterns are. And you can also probably factor in, once you've got a little rug rat at home, you're not going out as much, you're not having that same lifestyle, you're cooking in. So, there is a bit of a forced savings associated with that. But it is a key concern. When I think about the decisions that people make and the chances that they will want to have that amazing inner city lifestyle and then move out, I don't think it's always a conscious choice. I think that, for example, when people have their flat in Fitzroy and they're loving the lifestyle and baby's on the way and the flat's big enough for, a cot and a bit of extra living space to cater for a baby, they don't imagine life outside of Fitzroy. And it's not until it feels like the walls are closing in and Junior's toddling and there's stuff everywhere that they finally come to me and say, yeah, okay, we're willing to live in Reservoir. And if you'd asked them that before they had a toddler, they might not have They might have said, no, we'll just work out a way to make it work. We're city folks. We're never moving. So it is very difficult for people to be able to join those dots and take that step, make that decision, I think.
And I think that's where the difference is if you understand the numerical changes. So the changes in your income, the changes in your cash flow, what that means to borrowing capacity, it's a number. What that means to your purchase price, that's a number.
Yeah.
If you actually map out a plan, which are a set of numbers, you can see the real difference. Now, there is a risk because you are going to have to plan for the period where you're on, instead of, say, two incomes, let's call them both 100%, so 200%. Someone drops down to zero income for a period, then they might go back to working 2 days, so 140% of their previous income of 200%, or 70% of their 100%. Point is, you do need to factor in, but if you build the right buffers in place, you also have to train your mindset. Okay,
Yeah.
so we'll talk to our clients about the fact, look, you might tread water for 2 or 4 years or 5
Might
years.
erode your savings.
You might erode some savings whilst, spouse number one is not working at all. Then when spouse number one goes back to working 2 days a week or 3 days a week, you'll start having positive cash flow again. Okay. You've got to actually develop a mindset to not freak out when you hit these situations, because what happens often is people don't have these conversations. They don't do the numbers. And when they get major life events, changes, they freak out and sell property, or they don't have a plan. And like you said, then they're limited by what they can do, say with the family home in that example that Kate's used of moving from the unit in Fitzroy to the home in Reservoir.
Yeah, I think you've articulated it really well, Dave. It's about having a plan. And if your plan involves filling up your offset account and then letting it erode, and that's part of your plan, it's a deliberate expenditure, people will rest more comfortably with that because they've engineered it that way.
Yeah, and they understand the cause and effect. But when they don't understand the cause and effect, they just see their cash savings going backwards for a period of time. They don't really understand why. That's when people, get stressed, and it can have all sorts of ripple effects on the family unit, selling assets, etc.
Yeah, no, well said. I'm going to move into our next question. We've just had our first long-awaited cash rate cut from the RBA. Mike, what kind of impact do changes to the cash rate, whether up or down, have on borrowing capacity?
Well, sometimes nothing, because the banks aren't really compelled to pass it on. I mean, it's funny, like the politicians are like, ANZ didn't pass it on, shame on them, sort of thing. I mean, this is not a socialist country. These are private entities that can do as they like. But of course, in this particular rate cut, I'm pretty sure everyone's passed it on. But if we look at the last rate cut, it was 25 basis points. So we're talking about 0.25% rate cut. So prior to the cut, owner-occupied rates, let's say they were sitting at 6.15%. You add that 3% buffer, which is another story in itself, because Liberal have come out saying that they're going to look at that as part of their election promises. But you add that 3%, then we're repaying at 9.15. If we take that 25 basis point into the mix, it cuts it at to 8.9 when you consider that you bring in at, say, 5.9% rather than 6.15 as the 25 basis cut. So 9.15 to 8.9. So in and of itself, it's not a big thing on paper. But if we see a series of cuts like is priced into the market, and like we typically see happen, once we go up or we go down, we have a number of these things happening. It can make a difference when we're adding those things together to what people can afford. So rate cuts can just open the door to people because of their borrowing capacity and give them more options. But On the other side of the equation, timing matters as well, because it can also put fire under the backside of the property market, as everyone who now wants to take advantage of that extra borrowing capacity is fighting. So you could actually be in a net negative position if it fuels a little bit of a boom and you're a bit late. Of course, on the other side, when interest rates rise, borrowing power can shrink. Lenders assess your ability to repay at a higher threshold. That limits how much you can borrow. History has shown, though, is that, as we explored in the episode on how the interest rate rises affect property prices, that rate hikes don't necessarily lead to declines in property prices. The recent market strength in, say, Adelaide, Brisbane and Perth in 2024 in an environment of higher interest rates or even rising interest rates show fairly well as a case in point.
Yeah, very true. Dave, can you give us a real world example of how much borrowing capacity has increased as a result of the recent RBA rate cut, and what kind of uplift we might see if a few more cuts come through as expected later this year?
Yeah, so let's just go with an example of a single person earning $150,000 a year. They're looking to buy a home. They have no kids yet, no other debts, and their living expenses are around 2,800 per month, which is pretty low, to be honest. The extra 25% recent cut will only give them about 20,000 more dollars in borrowing capacity, which really doesn't sound like a lot. However, if we see the further 3 rate cuts as predicted, bringing the total reduction to a full 1%, then that same borrower would be able to leverage an extra $75,000. So at an 80% LVR, that would mean they'd have open to them another $100,000 into the property market. So that's a material shift in purchasing power. And this has the potential to influence property prices across the market over the next 6 to 12 months. And there's no doubt savvy investors and strategic buyers are already factoring this in and positioning themselves ahead of the curve to take advantage before price growth potentially ramps up, particularly in certain markets. For a couple earning $300,000, this recent rate cut might get them an extra $35,000 of borrowing, but a whole $150,000 with a 1% reduction, and that might mean an extra 200,000 into the property market. So while the 25 basis cut can seem pretty minor, these examples show how each cut can compound your borrowing capacity and make a meaningful shift into the property market. So again, if you're looking to purchase in the coming 6 to 12 months, it's really important that you understand that these predicted reductions will have a flow-on effect to the property market in the coming year or two. And certainly, if the coalition get into power, they've talked about reducing the buffer rate of 3% and probably potentially bring it down to 2.5 or even 2. So these changes will have an impact on the property market.
Without a doubt, if the coalition were to cut the servicing rate, the buffer rate, that could potentially be, an entire percent. That's significant, especially in sync with any further rate cuts.
Just on that one too, if I might ask, because I've been out of comms, I did hear it as a sound bite, but I presume they were just looking at first home buyers, not a broad, like the whole market would reduce that buffer.
I've heard it mentioned a bit regarding first home buyers and the whole market.
Yeah, right. That would make a big difference. I mean, for both cases, but first home buyers, what are we talking? Somewhere between 10 and 30% of transactions on average. It's not super meaningful, but if it's across the whole market, like you were saying, Kate, like we're talking about 25 basis points, but the serviceability buffer could reduce by 4 times that.
Yeah,
Like that make a huge difference.
I'd be so surprised if it was just open to first home buyers and no one else. And the reason I say that is that they're a vulnerable group.
The reason you would consider it with first home buyers is because their income is set to grow the most.
Yeah.
because they're the youngest, they're the least experienced, they're in the lower end jobs. They've also got the longest runway to pay
Mm.
things off. The risk is they generally have the highest LVRs.
Yeah.
Yeah, you're right though. Like, it doesn't make sense that that's the decision from a risk profile perspective, but I don't think that's what it is. I think it's a political thing. I think it's just
Yeah.
more about what are we doing to help first home buyers rather than, the banks. You should really have a look at yourself because these are low risk people. I think they are higher risk people, but as
Yeah.
Dave said, they got that bigger time horizon and bigger potential for wage increase over their life as well. So there is some balance.
Well,
And those points have been made by.
if we take into account the average first home buyer age, it's surprisingly high. I mean, we get to meet a lot of people that are in their 20s buying property, but the first home buyer age is actually over 30. And it could be argued that they're at that family stage in life as well, which, would compound the challenges associated with no buffer rates.
Mm.
Yeah, I think. Look, our one of the points that are being made is that we're not taking enough risk with lending since the Royal Commission. Our arrears rate, despite the fastest rising interest rate period on history, is still really low, and so the case is being made by those prosecuting this point is that there's not enough risk taken with our lending, and so there is room to move on that buffer rate from 3% down to say 2.5 or maybe
Yeah.
lower.
Yeah. Good point.
I really
Um,
think like the biggest mover of property markets, if we're talking about macro levers, is the availability of credit, right? And this feeds directly into that serviceability buffer. And if we think about when that came in, the environment was very, very different. We're in an environment of the trajectory was a rise in rates, so it made more sense. But it's not kind of tempered on the way down,
Yeah, and that's part of what they're saying too. That point exactly.
Mike, a pay rise or a second job will boost your income. Can you shed some light on how an income boost translates into borrowing capacity?
Not at all, but Dave can, and thankfully he's given me some notes. So, I'm not even going to pretend that they're mine because it's not my area of expertise. It's a privilege to have Dave on this particular show, and especially now because I think everyone's trying to figure out how to win this game. So, thanks, Dave, for doing some homework for me. If let's just start with our standard person earning 150K a year, no major red flags in terms of debts or dependents. It's a weird way to describe children, red flags, but I don't know. You haven't met mine, but you might say the same. Living expenses of 3.5 a month. So a $10,000 salary increase to 160 gives a borrower an additional 51K in borrowing power, about 5.1 times the salary boost. So that translates to a $64,000 increase in property value at an 80% LVR, which is quite meaningful, I think. However, as income climbs, the benefits do taper off a little bit. So a 50K salary bump to 200K, the borrowing capacity increases by 248, which sounds great, but it's only 4.96 times the income rise, as distinct from 5.1 with that extra 10K. But it will allow the buyer to target properties worth 310K more, which is a massive increase. So definitely ask your employer. Obviously, none of my staff listen to this, but ask your employer for a 50K pay bump and you'll get 310K. The slight drop in borrowing efficiency, so it begs the question, well, why doesn't it sort of work the same way? It's tax, right? Because once your income gets to 190K, you're on that 45% marginal rate of tax. So less of the pay flows through into something the bank sees as actual income in your pocket. So that also highlights an opportunity for couples where one partner isn't currently working. If that person increases their days when they return to work or go from 0 to 1 or 1 to 3, that can make a difference to the borrowing and the purchasing power and opens doors that you might not necessarily have been able to open without that person back in the workforce. So If we then go to a situation where we're looking at a couple, let's go to the same couple, 150K each, so 300K living expenses at 6.5, a 10,000 increase results in the same uplift in borrowing capacity as it does for the single person, around 51K more borrowing power, translating to, say, 64K if we 80% LVR it. You might expect a dual income household to gain more, but because the additional 10K is taxed at the same marginal rate as it would be for a single person in that bracket, the net increase after tax is virtually identical. Same is true with a 50K bump as well. So let's say we give one of the couple on 150K a bump to 200, the capacity increases by 248K or 4.96 times the income rise. So that gives them 310K more to play with. Where it varies a little bit is when both partners receive a 25 pay rise each, taking their individual incomes from 150 to 175. In this case, the combined borrowing capacity will only increase 5.1 times. Really, that's just another way of saying what we said before. It's about the tax side of things. And we've got some beautiful numbers that Dave's put together in a table that I'm sure will find its way into the show notes as well.
Straight into the show notes. Absolutely.
Put those numbers together.
Thanks, Anne-Marie.
Give her a
Now,
shout.
Dave, big shout out to Anne-Marie. She does a lot behind the scenes. And also our listeners get to hear Anne-Marie. She talks through the episodes you might not have heard, or the things that you should go back to, our resources. She also sheds light on next week's ep. So, she's...
Did we get... Sorry.
We'll be very familiar with Anne-Marie's voice.
Yeah, she's got a great voice. I love Anne-Marie's voice.
I was just about to say, like, when we caught up at your event last year, Dave, we got a photo with Jamie, our audio producer, and Anne-Marie, I'm pretty sure. We got to get that out of the archives.
Yeah. All right, I'll put it up on socials. Dave, what about someone who's on the verge of a promotion or a pay rise? Should they wait for the income boost before they apply for a loan, or is it better to get into the market now?
Yeah, I thought this was one to tackle because I think sometimes people can delay making decisions, and often they're looking for a reason to delay and procrastinate. And this is one that comes up at times, but really one of the biggest factors to consider is what the property market is doing. If you're in a rising market, waiting for a promotion or a pay rise could cost you more than it helps. So if we take an example, and let's say you're expecting a $10,000 salary increase, that, as we just went through, that could boost your borrowing capacity by about $50,000 and your purchase price by about $60,000. That's great, but let's say you're looking to purchase a property for $1 million and the market's growing at 5% per annum. That's $50,000 the market's growing per year. So, the boost you get is only just sort of keeping up with the market growth over that year. So, look, if your promotion is just around the corner, perhaps it's worth holding off. But even then, I'd still suggest getting your pre-approval organised now. And then when you get the income increase, update your application then. You really don't want to miss out on the ideal property simply because you weren't in a position to take action. I think that happens a lot.
Yeah, it does.
If the market is really heating up, the reality is you could be priced out altogether. You could be bumped down a outer suburb, from one suburb to the next suburb out. You might need to purchase a smaller block of land, one less bedroom, etc. So generally speaking, if you're thinking about buying, unless you're having a significant salary increase and you're certain of it, I would recommend continuing to move forward with your property plan, your mortgage strategy, your buyer's agent, secure the pre-approval and be ready to move if the right opportunity arises. Even more so if, your increase has a fair chunk of bonus or commission built in, because as we're about to share with you, lenders won't factor in 100% of this income.
Yeah. Yeah. Very well said. And it's so common to be working with people when something really suitable comes up. It might be just a bit different. It could be in a suburb that is, a bridesmaid suburb to where they're searching, or it could be a property that um, has a great land size, but the dwelling itself is not quite what they would have liked long term, but they were always planning on doing a reno, and it comes in cheaper. So yeah, I think it's good to get out there and take advantage of the opportunities that are there. And if it so happens that your pay rise comes through and you still haven't purchased, as you said, Dave, just put a new one in.
Yeah, increase the pre-approval then.
Yeah. There's an important distinction when it comes to bonus income. And Mike, we touched on this back in episode 116, which you went there for. But for those who missed it, can you give us a quick recap on how lenders treat bonus income differently to base salary? Now, I'm assuming you've skilled up and listened to that ep and read the notes.
Yeah, no, absolutely. It's banks being the fun police, like the rent shading. Like they never take 100% of those sorts of things. They'll take 100% of your salary, but everything gets shaded. Which
only your base salary.
Yeah, only the base salary. So, I mean, that's hard for some people because I know commissions. The idea is that you could get one week and not the other, or 1 month and not the other. But a lot of people live on a fairly consistent commission income, so they really are kind of capped by that base, and that's something that I think everyone needs to think about if they're in that particular position. But the key difference is that the base salary is the guaranteed assessable income, whereas bonus and commissions are usually performance-based, and of course they can vary, and that's the bank's interest in this. So if you're receiving higher duties allowance but haven't been formally appointed to the role, a lender may not include that extra income in your assessment. Because of that uncertainty, lenders take more conservative approach when they're assessing your income. So typically, base salary, you get 100% of it. A variable income such as bonuses and commissions or allowances means you might get 75 or 80% if it's counted towards your borrowing capacity. And most lenders will want to see a track record. So we're talking probably 12 or 24 months of receiving that variable income to allow them to establish a bit of a trend to be comfortable to take it. And if you've only been in the role for less than a year, it's likely that they won't include it at all. Whereas base salary, you can kind of set your watch to it to some degree. It's much easier for lenders to verify and accept. You can get letters from your employer to say you're employed on this basis, on this salary in a full-time capacity. So yeah, look, I suppose it's a risk minimization strategy from the bank, but as Dave sort of put before, like we do have really quite internationally low arrears rates in Australia, and I just think it's the banks being a little bit mean. What have I missed, Dave?
That's a good summary, Mike. I think you've nailed it. I think one point I'd really like to make for our listeners is the importance of lender policy. And 9 out of 10 people, as we said on the last episode, tend to have some sort of variable income. Therefore, matching your circumstances to the lender policy is really important. It plays a huge role in which lender is right for you, because not all lenders treat these things in the same way. So an example, we say bonuses and commissions and some of these variable areas is some will take 70 to 80% of the higher bonus you've earned in the last couple of years. Some will average out the last 2 years and then take 70 or 80% of it, which means you're actually getting 50 or 60% of the higher bonus year, not actually the 70 or 80%. So it's even lower than you expected. And there are some lenders who'll give you 80% of the lower year. So it isn't as simple as just 80% of the most recent year or the higher year. So you often end up receiving less than 80% of your bonus. So forget about 100%. It's often even less than 80%. But there are some specialist non-bank lenders who can accept 100% of your bonus income. So if there are usually trade-offs of higher interest rates or slightly stricter loan terms, So it's a matter of when you're looking to purchase what are you trying to prioritize? Are you prioritizing the loan? Are you prioritizing the interest rate? Or are you prioritizing the quality of the investment property you're going to purchase? Or are you prioritizing the home you're going to buy?
It's a
Because I
good
think
point.
some people get too caught up in the interest rate
Yep,
or
I
the
agree.
lender, and that means they end up not actually exploring options that might mean they could actually access another $100,000 or 200 and get into that house they want or that suburb they want, but they've been so taught to think about the interest rate first, they actually miss out on those opportunities because they don't explore a second tier lender because it has a slightly higher interest rate.
Yeah, it's counting cents, not dollars.
Mm. Yeah, short term
Totally.
thinking.
Yeah. Um, what about someone on parental leave who's returning to work? We spoke earlier that a lender may consider your future income if you get a letter from your employer confirming when you'll return and what your salary will be and your employment status. But what about where a portion of your income is from bonuses?
Yeah, so if you haven't been in your role for a full 12 months, then it's a good chance the lender won't include much, if any, of your bonus or variable or commission bonuses or commissions. Okay,
Yeah.
so again, if you're looking at moving jobs and then there's a fair chunk of it will be bonuses and commissions, you may not be able to borrow for until after or to the level you'd like to until more than 12 months after you've started in that job. So these are the
Mm,
types of things you want to understand before you make those decisions. And if there are things to tweak with your finances to refinance, so you're in a better cash flow position before you take on that job, or before you start your business or before you have children, you should be looking at these things beforehand, because for most people, your debts are your highest place of risk in your life. So it's also the place where you should be looking to manage risk the most. And that's why fixing can be a consideration, even if it is seem to be a higher interest rate, but it gives you certainty. It's where, you could look at interest only, even though the interest rates are slightly higher, but you just have that greater flexibility and buffer in terms of repayments. You should consider these things because it's not all about the product or the interest rate. It's also, well, I'm taking more risk here. So how can I manage my biggest risk? And that's my mortgage.
yes. Yeah, great. Now, when it comes to variable income like overtime, higher duties, allowances, or commissions, what do lenders typically need to see? Like these types of income are common in fields like healthcare, emergency services, sales, finance, and executive roles. So, how are they assessed and what documentation is usually required?
Yeah, so you'll have to provide more documentation than you expect to provide
Yep.
as a
I
general
already
rule.
expected a lot, Dave, and now I'm disappointed.
So if you expect a lot, that's the mindset you should go in with. Um, you'll need to provide your most recent income statement from the ATO, generally showing last financial year's earnings. You'll also, if you're expecting higher variable earnings in the current financial year, some lenders will want to see your most recent payslip and for it to have your year to date earnings, and then they'll annualize it. Now, you may have had pay rises during the year, but that won't factor in sometimes because they'll just annualize what you've earned over the whole financial year, which again might cut out some of your income. And people get surprised by these things. Um, Again, they might shade 20% of it. You might only be able to have 70 to 80% of it factored into your borrowing capacity. Um, Generally, overtime is treated a bit more favourably, especially for those in essential services like nurses, doctors, police officers, and paramedics. So, some lenders or quite a few lenders will accept 100% of your overtime if it's been consistent and it's been for long enough period of time. So, again, how long have you been in that job or that role will factor into these decisions. Once again, some specialist lenders will be more flexible in these areas than your banks, who are governed by APRA, whereas non-bank lenders don't have to meet APRA's strict requirements when it comes to lending. They also don't need to add the 3% buffer onto your borrowing capacity for your new loan plus all your existing loans. So there's a bunch of different things that lenders will need to see. And, if you're on higher duties, which more and more people seem to be doing someone else's job and getting paid for it, but they haven't officially been promoted. So unless you've already been, you've been made permanent in that role, or you can get a letter to state that, they may not factor in those higher duty allowances to your borrowing capacity. But people think, I'm earning this. Why doesn't it go towards my borrowing capacity? Because it's higher duties. You're not officially in that role, so you might need some documentation to confirm that you are going to get that job. You might need to have that difficult conversation with your employer that you've been doing the job for a long period of time, but they just haven't given it to you permanently. These types of things pop up all over the place. So, there's lots of different variables like this. And again, as I said on the last episode, it's probably 1 out of 10 people who just have a base salary and that's it. We love those people though.
Yeah, we've covered so much here, Dave, and that does wrap up the second episode in our borrowing capacity series, where we explored some of the key levers that can make a real difference to how much you can borrow, including variable income types, the cost of kids, the impact of falling interest rates. So a huge thank you to you and Mike for sharing so much valuable insight today, and big thanks to Anne-Marie for prepping our graphs and charts for us. If you've enjoyed this conversation on how to maximise your borrowing capacity, we'd love to hear from you. If there's a question we haven't answered or a topic you'd like us to explore in more detail in this area, just send it our way. We're always happy to unpack the finer points to help you make smarter property decisions. Stay tuned. We've got a third episode in the works where we'll dive into how you can tweak your existing debts to boost your borrowing power, from reducing or closing credit cards to consolidating personal loans and refinancing to improve serviceability. We'll cover it all. Also, we'll tackle one of the biggest misconceptions we see around borrowing capacity: interest-only loans. We'll see you next week, and don't go anywhere. Our gold nuggets are coming up next.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget was really something that Dave said that spoke to me. I mean, of course, this whole episode speaks to me about why you need a strategic mortgage broker. But he said, what are you prioritizing? And I thought that's a really interesting way to look at it, because I assume being a mortgage broker is really painful because everyone just prioritizes the interest rate, right? But if you are a property investor and you're trying to prioritize growing a portfolio, you might have an inside running on a hot market and it's worth paying a higher interest rate just to get the deal across the line. Or it might be part of a bigger strategy where you're kind of thinking, I need to grow this portfolio, but I've hit a lending ceiling, so I really need to get rid of this idea of I can see these rates advertised on TV for XYZ because I don't fit their model anymore. I've got a little bit more risks and I need to look at second tier. There's a million different things like, well, what sort of property am I able to get? So maybe with a higher interest rate, you're opening up types of assets that are much more blue chip, or let's say less risky assets, or there's less competition in that price point. So that was a big takeaway for me on this one.
Oh, I want to touch on kids because they are expensive. And I often talk to people that are wanting to jump into their next investment, and it's frustrating for them when their borrowing capacity is hampered or their plans have to go on hold. And, it's very different, the contemplating a family home, which you're probably itching to get into, versus an investment, which sometimes it has to wait. And what I will say, and it's based on experience as well, is for those years that you are home, whether it's 1 year, 6 months, or multiple years, that time with your kids, it is precious and they grow up really fast. So try to be kind to yourself and don't be too impatient, because once you're back on the working treadmill, you'll be able to go and get that loan and get back into your strategy. So be kind to yourself.
My advice would be, if you haven't, think about your income and think about if there's any variability in your income. And if there is, then you want to disclose that as clearly as possible to your strategic mortgage broker, and you want your strategic mortgage broker to ask you lots of questions, and the better they understand how your income is earned, then the better they can paint the picture, select the right lender, and get you the loan approval you deserve. So expect to have a good strategic broker will ask you lots of questions. A good strategic mortgage broker will probably need some extra supporting documentation, and it's better to be providing that in advance, and in advance of doing the lender assessments and the product and lender recommendation and before the lodgement, rather than getting into that painful position of having a loan lodged and then the bank asks these questions, and then you're asked, you think you've done all the hard work, and then you need to provide this document and that document, and that's annoying to you and everyone, and it just adds more time. So expect, if you have variability, you should want to answer these questions clearly, provide that information, and cover that all off up front, because then you'll be getting the best advice for your personal situation.
Great gold nuggets. What a great app. That was good, Dave.
Hopefully our listeners learned something from that.
Yeah, I'm sure. Well, we'll see you guys same back time, same bat channel.
See you there.
See you next week.
See you later.